Hello and welcome to the i3 podcast. My name is Wouter Klein and I'm the Director of Content for the Investment Innovation Institute. For more information about our educational forums for institutional investors, please visit our website at www.i3-invest.com. There you can also subscribe to our complimentary newsletter i3 Insights, in which we discuss investment strategy and asset allocation questions with asset owners around the world. Now, as you all know, we love our disclaimers in this industry, so here's ours. This recording is for educational purposes only. It does not constitute financial advice. Please enjoy the show. This podcast was sponsored by Lighthouse Infrastructure. As such, the sponsor may suggest topics for discussion, but the final control remains with the Investment Innovation Institute. Welcome to the i3 podcast. I'm here today with Peter Johnston, who is the Managing Director of Lighthouse Infrastructure, a sustainable infrastructure and real asset fund management company that more recently has been investing in affordable housing for key workers. Peter, welcome to the show.
Hi, Walter. Nice to be here.
So, how did you get involved in infrastructure and infrastructure investing?
Well, I studied economics and accounting at university. And shortly thereafter, my first job was working for a utility business. And during that process, very quickly, that went into supporting that business through the establishment of the regulatory framework in Victoria. I was lucky enough to be right at the table with the regulators while they were establishing the framework, and it struck me it was a lot like a puzzle. And I have a lot of interest in puzzles. So that drew me in to start with. Shortly after that, the industry started to rapidly expand in Australia with privatisation, and with that, a lot of really smart people came into the sector. And I was lucky enough to spend a lot of time with them, to learn, to grow. And, from there, that's led to the funds management industry, which has now established itself from a very, very small back in the 90s to a very substantial and significant asset class for institutional investors. So it's intrigued me for a long time. It's kept me interested and, as I say, really smart people to work with.
Yeah. I think within Lighthouse, there's different approaches, different strategies, but today we're going to focus predominantly on affordable housing for key workers. But before we get there, can you tell me a little bit about how Lighthouse got started itself? I think the history goes back to 2007?
Yeah, correct, Walter. My partner, Mitch King, established the business in 2007, coming out of Hastings, one of the leading infrastructure firms there. He established the business as a platform for other innovative and bright investment managers to come on and to innovate, to grow and create sustainable outcomes. First 10 years were mainly focused on advisory work in the renewable sector, also in a lot of social infrastructure and some transport as well. In 2016, I joined. We started investing capital there. And we established what was innovative at the time was a first large-scale PV solar investment fund. Shortly thereafter, we were able to innovate again. We were one of the first investors into specialist disability accommodation. And now it's onto affordable housing.
How did you get involved in affordable housing? Because if you look at it sort of from the institutional investor perspective, I think residential property is only just starting to sort of become interesting. This is quite sort of a specialized version of that. How do you get involved in that?
Well, it started, Walter, in 2018 when we started investing in specialist disability accommodation. We were drawn to that because of its regulatory framework, which was very similar to what we'd experienced in gas and electricity, transportation and utilities. What we discovered there was a dominance of the operators was the community housing sector. For those who don't know much about the community housing sector, in Australia, they operate about 25% of our social housing on behalf of government. They also provide their own affordable housing using their own balance sheets in many circumstances as well. I think they operate about 125,000 homes across the country. Some are utility scale, as we would call it, operating thousands of properties. When working with them, we were able to create innovation in the SDA space, which gave them a growth that they hadn't been able to achieve before. With that innovation, that led to them engaging with us heavily around their other problems. And their other problems, obviously, are affordable and social housing. We quickly from there zeroed in on the affordable housing sector as an area that we thought this could be something successful.
So in this podcast, we will focus on the investment side of things, but perhaps to just quickly paint a picture of the housing problem for key workers, can you tell us at sort of a high level how big this problem is in Australia?
Yeah, well, identifying who the key workers are is probably the first part. Imagine those people who during COVID we couldn't afford to have sitting at home on Zoom calls. They actually have to provide their services. So think healthcare sector workers, emergency services. We also do focus on the education sector as well. Many of these workers are essentially subject to enterprise bargaining agreements, and they cap their incomes and constrain their incomes. However, at the same time, we want them to be providing their services to us. So they operate, centrally, and in large cities, that's where most of us live, and most of us want to live. And in that context, access to accommodation in a highly competitive market for accommodation is challenging. So they're dealing with and competing with everybody while on those constrained incomes. Therefore, they either have to pay a lot of their income away in rent or travel long distances. So it's a specific challenge that they face. Looking at how bad this problem is today, when it focuses on key workers, a recently published report by Everybody's Home, sponsored by Anglicare, identified that in this country, key workers are paying away a minimum of 50% of their income in rent. To expand on that slightly further, they also identified that only about somebody who was on the minimum wage could afford to access 2% of the rental stock in Australia. So it's got to a crisis point and something needs to be done.
Yeah. And when we talk about key workers, is that mainly nurses and police officers, or what is who falls under that category?
We've expanded that to include anyone working within the health sector. Usually they are required to work within a hospital, so that can be cleaners, that also cooks, hospital administrators as well. When we expand it a bit further and we're talking about an area we're looking at closely now is essential retail. We do require people to, provide us essential food goods as well. So it's a broader sector than just your nurses and police. So that gives you a bit of a feel for it.
Yeah. Your first investment was made in 2021. Can you tell us a little bit what type of investment that was and how it helps solving this problem of affordable housing?
Yeah, the first investment, I suppose we closed on our first investment in 2021. The journey goes back to around 2018-19 when we started working on this challenge, and we identified St George Community Housing, or SGCH, as a really high-quality partner. They have an exceptional management team and board who embrace innovation. So we started working with them. We also collaborated with some of the leading law firms in Cause and HSF in this sector to design the model, to test it, to make sure it was robust, and also brought in KPMG. When we were ready, we then looked to go and apply that to product. We ended up, getting very attracted to a site right beside Westmead Hospital. For those who know Sydney or don't know Sydney, as the case may be, Westmead is one of the largest health precincts in the Southern Hemisphere, as I understand it. It involves a number of hospital campuses, education facilities, and a rapidly expanding growth area. This particular project is about 400 metres from the front door of Westmead Hospital, built to sell by a private developer. We were able to access about 15% of their stock. for our project converted essentially into key worker housing, and that represents about 85 apartments. We were able to let that up very quickly. Even during the Omicron phase, which was going on at the time, it took about 6 weeks to fully tenant that. And what we have now is key workers who are saving between $6,000 and $10,000 essentially after tax in their rent. And a huge change, the story we hear back from the tenants, just a huge change in their life and their capacity to be able to commit to their work, which is, I think, one of the things we need to identify from an essential workers perspective is their value to the community and how do we make their employment more attractive. Since then, we've closed another investment in 2022.
Okay. So what is sort of the arrangement with the essential workers? Do they get to rent it forever? Is there a set period? How do you structure that?
First, there's an eligibility criteria for the tenant. They need to be on low to moderate incomes. So we're not able to let these to people on much higher incomes. So it's focused based on need. They are able to access that property while their incomes remain at that level. So we do provide a degree of continuity, but circumstances change and people's incomes increase, and sometimes they move place of employment. So there is a degree of sort of turnover that occurs naturally within the tenancies. And the experience SGCH has been is less than 3 years is the average tenancy. So we're able to provide that. As it relates to the investor and to our relationship with SGCH, we're committing to a 10-year period that we'll be able to do that. So they'll be able to let these to people who are qualifying for the next 10 years. After that period, St George has the opportunity to buy that from us, or we can use that to sell to market. We are investigating together with St George now the capacity for those key workers to purchase that accommodation. So at this stage it goes for 10 years. There's capacity to potentially expand that over time.
Yeah. Why was that 10-year period chosen? Is that also that maybe these workers that start out on low to moderate incomes then are further in their career, or is that more an investment decision?
I suppose it's more about overall balance. When we set out to create this model, we're focused very much on trying to develop something that was attractive to an institutional investor. And with that institutional investor in mind, the creation of an investment opportunity that has a compelling return was really, really important. We've created a model together with St George here that produces that sort of compelling return, but it's unable to do it at this stage forever. So it has that constraint. The subsidy that we're able to create and the extra return that we can generate runs out. So after that period, St George might be able to repurpose that into another government program, but that's what it suits for our model at this time.
So affordable housing, you also mentioned earlier on there's some solar strategies involved as well. Obviously, a strong focus on sustainable and also doing good, basically. Is that a bit of a personal interest because you started off with sort of the regulatory background as to how Lighthouse got started, but do you have sort of a personal angle to this?
I think all of us searching for the capacity to be able to contribute to our community, to be able to do that in a professional context is very rewarding for me. And, for Mitch, who founded the firm, this is the establishment of the framework and what our value proposition is to investors and purpose. Doing at the same time, it's the same value proposition that we offer to employees, the ability to contribute to your community and do well professionally and earn, an appropriate income from doing that. So it resonates. It's very compelling.
Yeah. Now, sometimes there's been a discussion in sort of sustainable and socially aware strategies around, does it actually pay off enough? So if we look at sort of that question, and I used an example of AustralianSuper because they have been on the record on this, that they said in this category of which basically falls on the residential property, they're looking for a return of at least 6 to 11%. In this type of strategy where you offer basically housing at a discount, is that sort of an achievable level?
Short answer is yes. I think we all thank Paul Schroeder for those comments. Often quoted they will be by those who are working in the affordable housing space and surrounds. That's the absolute need. So when we set out to create this model, creating, I suppose, not just a market return but a compelling return, we saw as necessary to attract investors and to make it sustainable. Without that, you're dependent upon government programs and other stimulus, which we think is a challenge for institutional investors to rely upon. So our model is deliberately focused on creating an attractive return, and that attractive return sustaining the outcome that it produces. So 6 to 11%, you're very comfortably within that bound.
To what degree does that rely also on subsidies coming from the government? Is that purely your own activity, or is there a subsidy element to this?
There is definitely a subsidy to it. Working with the community housing sector enables the community housing provider to generate a subsidy to sustain the investor in this. We are discounting rent. We are foregoing income. Any investor is going to need a supplement to be able to sustain that. We are using, I suppose, indirect subsidies at this stage, which is not dependent upon a government program. We think that's really important. When you look more broadly at the sector, there was a really important review done of the National Housing Finance and Infrastructure Investment Corporation, NIFIC, by Chris Leptos. It identified the challenge that's ahead. And the challenge ahead for social and affordable housing is we need about $110 billion over the next 20 years for affordable housing and about $180 billion for social housing. The subsidies required for those two are stark in their contrast. It's about 100% capital subsidy required for social housing. To make affordable housing work for the long term, noting we're only going for 10 years, you probably only need about a 10% capital subsidy. That means about 90% of that capital represents an opportunity for institutional investment to participate in this sector. That's what we saw as attractive, that's what we saw as scalable, and that's what we saw as appropriate for institutional investors.
Yeah. So this area can be scaled up. There is obviously a lot of need there. How do you sort of, from your perspective, make this scalable in terms of the vehicles that funds can invest in?
The scalability comes down to, firstly, we've identified that there is a sizable market demand, which is important, I think, at the outset. But when we started to look at how to scale this model, the production of that volume of housing and as an injection, we identified as unlikely to be successful if it competes with market housing. It's most likely to be successful if it is supportive of producing market housing. So our model really works within that private developer world and supporting private developers to be able to produce affordable housing rather than demanding that of them. So I think one of the key ingredients that's been missing from this sector has been access to capital. I don't think there's any, from our engagement with developers, there's been very little unwillingness to want to participate in this sort of program, and the developers that we've dealt with to date have wanted to do more, which obviously gives you an indication that it's being successful for them. By working with and collaboratively with the private development world, we're not competing for access to land. And I think that is vital if we're going to solve the mountain of problem that is affordability. We need to essentially co-produce affordable housing and market housing. We need both. So trying to have a separate channel and a separate competing capital market for the access to that land and development, we think is unlikely to produce a successful economic outcome. We'll also need to have scaled operators, and the community housing sector today are the largest build-to-rent or landlords that exist in our country. Many of them very professional organisations and capable of partnering with institutional investment. So that operational capability already being on our doorstep, we saw as a huge advantage in being able to apply this. So being able to work with private developers, being able to work with the community housing sector, we think these two ingredients are vital in creating scaled solutions.
Yep. Now, there's obviously an element involved with the government, with regulations, with how to define this. Can you tell us a little bit about how you manage risk in this perspective, and is there a higher sort of regulatory risk in this space?
The regulatory risk that exists is the same, essentially, regulatory framework that operates for community housing providers today. So everything that we're working with and using within this model is being utilised right across that sector. Our engagement in developing this model, Federal Treasury has been fantastic in their interactions with us, and we've been very transparent about it. I think that stability of regulation is also it's a vital ingredient, and being able to engage with them around the outcomes that we're producing. At the end of the day, we are reducing the burden on the public sector to be able to produce goods for the community, and that is of itself also a great protection combined with existing statutes.
Yeah. Now, you mentioned earlier the National Housing Finance and Investment Corporation. I think it has been renamed Housing Australia recently. They have played sort of a pivotal role in making this more attractive to institutional investors. What do you see as their role going forward in helping this build out the sector for institutional investors?
I think the guys at NIFIC have done a fantastic job in developing the sophistication within the community housing sector. So NIFIC's role to date has been to create and support and expand the community housing sector. They've done that through a housing bond aggregator program, and in doing so, qualifying for that program has required a degree of reporting and sophistication that may not have existed in the community housing sector before. The legacy of that we are inheriting, which is, and I mean that not Lighthouse, I mean that the broad investment community. So their sophistication and understanding around reporting now is at a level that didn't exist before. The role is about to change significantly, essentially to be a subsidy provider for a number of projects. It would appear with the Housing Australia Future Fund. They run and have quite a difficult balance within their mandate, and their objectives, I should say, is to stimulate private sector investment. The challenge for us and the challenge for many institutional investors is any program is going to come to an end and therefore may not be sustainable. Their challenge is going to be over the next few years is how do they catalyse so as an industry can sustain itself rather than necessarily rely on NIFIC. That's where we think programs like ours, which don't require NIFIC support, don't require government support, we can assist in growing that and expanding it, and therefore enabling them to focus on more maybe challenging opportunities.
Yeah. Most of our listeners come from a pension fund, superannuation sort of background, and so they look at investments in the context of a broad multi-asset portfolio. If we sort of go back to basics on this type of investment, where does it sit? Is it actually a property investment, or is it a sustainable investment?
Really good question, Wouter. The reality is it's a mix. In terms of underlying investment risk, it is definitely property at the core. What we're supplementing it with is an income stream that looks very much like a public-private partnership, so very much synonymous with our world of infrastructure investing. So we've ended up, I suppose, with a hybrid, which is a property investment that's supported by an infrastructure-like investment. That combination, we think, produces an outsized return. And the trade for that is committing, for investors to commit for a period of time to be able to support the community and enabling them to use that asset. That combination is commonly used in the infrastructure world, and that is when developing PPPs and other type assets that don't necessarily produce, in some cases, any income, like court facilities and the like. Time is what essentially the community needs, and in their return for time is a compensatory income stream that comes back to the sector. Whether this is a sustainable investment, we don't necessarily think that sustainability in a social context can be done without profit. So focusing on this again as an institutional investment outcome, profit will sustain it, but it does produce a social dividend. And that we think is the important combination, and in that order, particularly for institutional investors that have to be guided by the best returns available.
So the key characteristics are property related. So if we sort of look within that context, I think we've all known sort of the problems we've seen in other areas of property, with especially the retail side, which has been challenged by e-commerce, office more recently by working from home and the changing workplace. So it seems that this has created more interest in residential property itself as well. Do you think that that's sort of helped drive the interest in this space as well, or how do you see that developing going forward?
I think the challenges within asset allocations are omnipresent is probably the best way to describe it. I think every industry and every asset class faces different challenges from different times. The offering that we have here today is for an Australian investor, and actually for an international investor, is not unique, but it's new. We are offering the institutional world build to rent as a model in a definitely a private market rental type context. This is another opportunity which could also exist alongside that. How investors would seek to use that, we're really conscious of the Your Future, Your Super benchmarks, which all superannuation funds in Australia are subject to, and this undoubtedly we think will fall into that property allocation. So we're focused on, I think, not just where returns are projected to be from property today, but where they are historically been as norms, and our objective is to produce a return that will compete against those outcomes. Why is there a lot of interest in the space? I think there's investment challenges, but I think there's also national challenges, and there are international challenges associated with housing affordability. So I think there's an investment need, there's a social need, it's got a lot of attention, but what will sustain it is attractive returns as the only thing that will ever keep it alive.
Yeah. That element that you mentioned before, where there is sort of an infrastructure framework around it, does that help as well with getting more sticky and more stable income?
It does. It enhances the income. It elevates the income above market rent, which we think is really a necessary element for residential housing as well. In a context at a retail level, banks are very comfortable lending to individuals who are prepared to provide access to their separate source of income for service. When they're doing so, they're really comfortable with going to very high loan-to-valuation ratios. One of the challenges associated with institutional investment has been, is rent alone enough to sustain a debt position? So not only were we faced with the challenge of only starting with that market-based income, but we were starting behind, which actually we were providing discounted income. So we saw that as one of the most important challenges that we needed to face, was actually to make this sustainable. It needed to be attractive to lenders as well as to equity investors. And that's been, a hallmark of the property sector's use within an allocation, is to produce income. So our subsidy that we are achieving through this model is being provided in income that will sustain equity investors. It will enhance the income stream that's achieved, which will enhance the cover ratios that lenders can also achieve, and therefore be able to sustain higher loan-to-valuation ratios and therefore drive returns harder as a consequence as well.
Yeah. So you've made, I think, 2 investments, you said, under this particular strategy. What is sort of the ideal investment? What does it look like? You mentioned, for instance, it's important that it's close to a hospital if it's for that particular key worker. What does the ideal investment look like in this space?
The ideal investment is one that can be repeated. And that's, I think, what we have been able to do to date. So I think the problem is unlikely to be the ideal project. It's just repeatable projects, because this problem is right across the country. It's not in a particular location. It's not within a particular locality. It's not actually within a particular sector because we do operate almost completely with a fully competitive market. The challenge we have is if we don't address it, how are we going to solve it? You look at our key worker satisfaction measures today, and I think everyone within the global community is concerned about what we've done to healthcare workers, but it's also been emergency services workers who've also been facing enormous challenges. They can work in other places, they can work in other industries. We need to sustain our community by supporting them as much as we can.
Yeah. So if we do a little bit of crystal ball gazing, what are your predictions or your estimates of how this sector will grow as a sector itself, but also what are you trying to achieve with Lighthouse itself? What sort of size fund do you have in mind?
I'll start with, I'll go back again to remarks I made earlier about Chris Leptos's report, where he clearly set out with the work that Treasury did with him, the affordable housing need is $110 billion. So that's what we actually need to deliver. It can be delivered with private capital. It can be delivered with private capital that can achieve an appropriate return. So I think that's what we want people to understand about the investment opportunity. It is in the tens up to $100 billion just in an Australian context. So to solve our problems, we need to produce that, and private sector can play a really important role in doing so. As it relates to Lighthouse and what we're looking to achieve, we believe, I suppose we're slightly different from others in that we don't believe many models will make it work, but what's probably most important is the generation of a capital market to make it work. And a capital market has a well-understood risk framework. It's repeatable. It is an area where investors can increase their weight and decrease their weight, and doing so they can take primary opportunities, invest in new projects, but knowing that there's a market that sits behind them that understands these risks, and there will be a secondary market available for them because investors will be able to trade their positions. If you come to that conclusion that that's actually what we need, Lighthouse can play an important role, but there must be other participants. We're looking to establish a platform which will take our $120 million that we've invested to date up to $1 to $2 billion. We've got a pipeline of projects that should be able to achieve that comfortably over the next 2 years. Beyond that, a capital market will need other participants. And I think today superannuation funds certainly engaged with the challenge. They have the capital to be able to produce a solution for this, and a good framework around a model like ours to be able to scale that investment up and solve this challenge.
Yeah. Peter, thank you very much for your time. It was much appreciated.
Walter, lovely to be here, and thanks for the interview.
Thank you for listening to the i3 podcast. For more information, please visit www.i3-invest.com. Thank you very much.